the event this morning. I'll show you. Here, they have a very nice merch, and they have gift for everyone. Yeah, yeah. I have a bag. It was early cards. So I'm gonna apply for it for night tomorrow. It's also my name so busy. Sorry, I keep complaining.
This is a good thing.
I know.
So you get that job.
That is one of my big goals of the year. Yeah.
Budgeting.
I have
Budgeting
sorry?
It's for free. It's for free. Would you buy this?
Where I read about it.
Would you buy this?
My friend the other one, the one that I want to I got it for free. I got the name.
What made you
Just look down. This was a mistake. But it's okay. It's gonna get longer soon.
Why should you put your mic in this?
Sorry?
Why should you put your mic in this? Then I showed you the old bat. It's kind of like, look at those. That's exactly how my hair used to be.
Straight hair.
But that's what take those topicals does to your hair. It goes all away.
This is the longest hair I have in my life. Really, longest hair I have. Usually my hair is just around here.
You used to have it like here.
You?
You used to have short hair.
Yeah, I saw you already.
Well, your Facebook has it.
We just arrived last summer, right? I was busy with the Black Rock.
Well, like,
A little bit.
just you just see like Rumax, like the ETF is like about 40%.
40. Not 1440.
For one short.
14. Yeah.
14.
Yeah.
So I had a good guess.
Did.
You guys sweet now. You guys sweet on the top. Green.
Let me have a look. So it will
Next time,
be
bring the
on,
next time.
Your nails are so it will be on February like 14th.
13th.
The Friday.
That Friday.
Okay.
Or March?
March.
No, yeah, February. Oh, no, sorry. My fault.
Actually, like, there is no exam. Thank you.
Bring the next time.
Some random Friday. Friday the 13th? Yeah, because he didn't come to class on Monday, so he's making an exam on next Monday and Friday. It's in person too. I hope it's like the way his other exams are.
three, probably half of the recommend. Let's look at that, it looks like it's all memorization stuff. When is that, that's on the 15th? Partial income is, that's 2 weeks out of lunch now. And then you have
This meeting is being transcribed and summarized.
it would be a Friday. Friday the 13th, I think.
You're recording, right?
But, you know, keep me in check actually, because today I remember.
Sorry, you asked me to check.
Yeah. Okay. All right, everyone, so, welcome back. Let me tell you what we're gonna be doing today. So we're starting to obviously, learn the 8 quantitative way of finding, optimal portfolios. And a critical piece of information is the covariance structure, right? Because that's how we control risk, right? That's literally what we've learned so far. You know, if I had an actual portfolio like you guys have on StockTrack, one thing I can do now is I would, based on the weights of my portfolio, I would get a portfolio return, correct? And then based on that portfolio return, I could find the efficient portfolio. And that would give me some idea on what the optimal weights are. Do we all understand what I'm saying, right? So you can actually do that right now, not right this minute because you have things to do, but you can do that actually if you know how to, you know, since you know, or it's easy to compute the weights on your current StockTrack portfolio, you target that return and minimize standard deviation, and you're gonna get maybe some revised weights, right? Well, so today we're gonna start by making sure that everyone can actually individually find these efficient portfolios. That's number one. Then we're gonna talk about the CAPM. So the CAPM is very interesting. Number one is the most popular finance model in the world. One of the main reasons is because it's easy, right? By the way, raise your hand if you've heard of the CAPM. I'm assuming you have. And so we're gonna discuss it today with more technical details on what you know. And I know that you know a lot, but there are technical details you need to know. And so it's interesting because, and that's why we're gonna talk about it today, because of two things. So it's got a prescription for how we should be investing, and I've already told you what that is. Basically the CAPM, you guys know that the CAPM formula starts with what? What is the first variable? Risk-free rate, right? So it does assume that there's a risk-free rate. And automatically you know that the prescription then is we all should invest in that particular risk-free rate and S&P 500 ETF. That's it. We don't need to learn anything further. Now, of course, absolutely no one in the world does it that way. So that's one interesting fact of the CAPM. It's very popular, and yet that prescription is not used by anyone. But it's popular because there's another prescription, which is the one that you guys are aware of, which is the pricing part, meaning the return, the rate of return that we should expect from a specific investment, right, based on its beta, right? Everyone uses that, and here's proof. If you go on Yahoo Finance, Google Finance, Bloomberg, Morningstar Direct, whatever financial information system you're using, when you look at a particular stock, beta will always be there, right? It will be published. Do we all see that, right? And so it is the most used pricing model in the world. It's used not just in let's say asset management. It's also used in investment banking, in other words, corporate finance, right? So these are the two aspects of the CAPM that makes it interesting. For us, it's gonna make it interesting. One more thing makes it interesting. Understanding the CAPM will allow us to come up with alternative solutions. So these are solutions, right? And we'll discuss these solutions once I'm sure that everyone in class knows how to get these. But we also need to be aware of alternatives, right? That you should not just, use this and this is the Bible and whatnot. No, there are alternatives, or at least alternative solutions using the same principles. So the CAPM will help us go there, right? We'll use it for pricing purpose, so we're gonna use it to come up with alternative estimates of the returns. And then we're still gonna go through the same process, and now we're gonna have alternative ones, right? Where are we going with that? So number one, you need to be aware of all possibilities, at least the most popular possibilities. But number two, you're gonna end up with a range of weights, right? For a given return, right? For a given return, this is in, let's say 1.02, this solution will give you a set of weights, and then the CAPM alternative will give you other weights, right? For the same return, other weights, right? So for a given target return, what's gonna happen is that you're gonna be able to come up with a range of weights for each component of your portfolio. Does that make sense to everyone? Right? Because ultimately that's what you need, right? You can't, just because the model says, well, at this point, if this is the return you want to invest 0.93% of your capital in IBM. Well, that's great, but maybe you need some flexibility because there's many reasons why you should not strictly believe in 0.93%, right? And the more you're aware of the limitations of financial models, the better off you are, right? So we're gonna use the CAPM to come up with alternative returns that's gonna give us alternative weights, and that's essentially how we're gonna end this session, because that's gonna be the basis for your next assignment that's gonna be due next week, right? And again, the ultimate objective is for you to use this on your portfolio, right? But please note that this is more general. This has more general applications. Like, it's not just your portfolio on stock track that matters. Maybe you have customers that wants different target returns. You guys see the idea, right? And you can use these for that purpose as well. Right? Okay, so that's what's on the agenda. And so first thing I'm gonna do is I want you guys to have this on your laptop. We're gonna walk around and just make sure that everyone knows how to do this, right? And if you're not done with this, take the time to do that now, right? Because it is critical for me to know that you actually know how to do this before we move further, right? There's no point in moving further if there's it's like there's a baggage or something you left behind, and what's the point of rushing if we don't do this, right? So this is the foundational model, and then we're gonna explore a couple of alternatives. So I just talked to you about the CAPM, And then there's another alternative which is extremely popular, known as the Black-Liderman model. So some of you are familiar with Black-Scholes, right? Who's heard of Black-Scholes, right? So that's like again, a foundational model in finance to price European options, right? By Fisher Black and Myers-Scholes. At some point, Fisher Black worked for Goldman Sachs, I think, and he and a co-worker, Robert Liderman, came up with a way to use this in practice that's a little bit more flexible in the following sense. We're gonna be able to express, let's say you want to use the historical returns, but you don't necessarily trust what they are. Maybe you have opinions, right? So you're gonna be able to, their framework will allow you to express opinions on the future returns, and that's gonna allow us to update the return vector and the covariance matrix and rerun the same thing. So by the end of that whole process, you'll know of basically 3 alternatives, which is a lot more than you need to know, but that's what we're here to do, right? And all the whole point is that in practice, people use variations like that. They want ranges like the ones we're gonna get, right? All right. So who is done with this? So I can check basically that you are done with this. And if you're not, I just want to make sure that I can help you. So Clifford,
I've already done the whole portfolio for that I have. Essentially what your project is gonna be. That's my portfolio with all the optimization done.
right? And did you do this? I mean,
Yeah, that was last week's work.
huh?
I did that last week.
So do you have it with you?
Not on this computer,
Not yet. Okay.
but I've already done it all.
Okay.
Which one is we do?
Fantastic. That's fine. Okay. What for Jesus?
Where?
Okay. Looks good. Yeah.
I remember that being solved.
Yeah, so let me remind everyone of how to do that. So, just a quick reminder, right? So the whole idea is that once you have the return vector right here and the covariance matrix set up, once you have that, right? Then you need to set up a cell that sums up the weights, right? You have to start with some random weights. Usually you start with equal weights, right? And then you have to have cells that computes the portfolio return, right? You have to have a cell that computes the portfolio variance, and you have to have one that computes the portfolio standard deviation, right? And so once you have all of these set up, right, what do? We set up, we set up solver, so we're gonna go to data and solver, and we set up solver to do what? Well, we wanna say we minimize, so click on minimize the cell that contains the variance formula, right? So we want to minimize that cell by changing the cells that contains all of the weights, right? So this is C2, C6 in my case, right? And then you guys know you have to add specific constraints, right? So one constraint right here that I'm highlighting, C8 equals 1, simply meaning the sum of the weights should be 1. Then you want all of the weights to be positive or 0, right? So that's another constraint. And the way we started, the way you have to start the process is is by not targeting a particular rate of return. Right now, C12 equals A20 in English simply means I want the portfolio return in C12 to equal whatever the value that I have in A20. When you start this process, you need to remove that particular constraint because why? Because you need to come up with the minimum variance portfolio, correct? And the minimum variance portfolio literally is the safest portfolio you could get out of these particular stocks, right? That's the definition of it. So the only way you get it is by saying minimize the variance, find the ways that minimize the variance regardless of the return. Do we all understand this? Right? So that's how we're gonna get this, right? So first of all, raise your hand if you do have the MVP, right? So you need the MVP for sure. And again, I walk around and check your works. And then once you have the MVP, then we discuss this, right? Divide the distance between 0.77% and 1.18%, divide it equally so that you can add increments and you can have target returns. And then what you're gonna do is and you need, like I said, you need to know how to do that. Then what you need to do is, you're gonna add this particular constraint by saying C12 equals something, right? So it's gonna be A20 and then A21, etc., etc. And as you do that, what's gonna happen is you're gonna have different weights here that you're gonna get here, and just make sure to keep them, cut them and paste them
Oh.
like so.
So you do it out above and then you copy and paste it?
Yeah, that's what I did, right? Now, if you find that maybe pasting it just using
Do it as a
vertical,
transpose.
you can do it as well, whichever works, right? But the way usually we read this is one row is one portfolio, right? Cliff, what did you say?
It's easier to do it as a transpose. You just copy the weights and then transpose it
Right.
across.
Right.
Because you try to copy a formula, it's going to screw you all up.
Yeah. No, don't copy formula for sure. It's the value. It's the values that you need to copy, right? And so these are the two steps, right? Find the MVP first, and then find all of the other portfolios until you get to that last one. Remember the last one, right? The last one is always the asset with the highest return. Because logically and technically there's no other way, given that you're not allowed to have short positions, there's no other way of exceeding that particular return, right? So, okay, so let's get to work and make sure that you go through these steps so you can show me these. If you have questions, now is a good time to raise your hand. I'll come and help you. Otherwise, if you're done, also same thing. Raise your hand and I can check your work.
They show first on the solver somehow it disappears.
How to get solver? So that's a great question. So file, and then you scroll down to options,
You know how to get it?
Oh, I have it.
and then you're gonna go to add-ins right here. And you're gonna say go to manage Excel add-ins. You say go. There you go. And then you got that pop up and you check solver adding, right? Yeah. Yeah. So, actually, so, you don't, the idea is that you first could get right, using solver.
And then on this page.
And then to get the next portfolio, including the standard deviation, still you use solver. Right? Does that make sense? Right? So all of, the only thing you know is this, and everything else is computed with solver. Yeah.
The reason being transparent is
Yeah.
you try to use
Yes.
now.
So you say minimize. Okay, so let's check your, can you, yeah. So minimize variance, so that's good, right? And then by changing variable cells, which are C to Z, okay, so that's good. And then you want C to C6 to be greater than or equal to 0, yes? Yeah, that's it. And now if you click on solve, click OK. So these weights are the weights for the MVP. And this is the standard deviation, right?
Yes.
Yeah. And so now you copy and paste so that you end up with a row like mine.
Okay.
Make sense?
Yes.
You know? So that's an MVP is what you're saying. Okay. Alright, looks good. And so next thing is just move on. You have to add that constraint, that return constraint. Right? You say you have to add a constraint that says something like C12. So hold on. Actually forget about this. Let's cancel. Right? The first thing you need to come up with, and let me actually do the one. So for those of you who are starting this process, please make sure that you absolutely fill out this column, right? How do you do that? Compute the difference between 119 and 0.77, divide it equally, and then you increment each one of these returns. These have to be filled out for you to be able to run solver, because these are the target returns. Do we all understand it? Yeah. So let's make sure we do that.
Oh, sorry.
Don't fight, guys. Come on.
Is it why the 77 again? Can you explain that part? I understand the 119, but the 77, why did you start there?
Oh, that I did not.
Oh, okay.
So
You just picked up the first time you were in solver.
Oh,
It'll tell you that.
so literally,
and then 119 is the largest one, the largest return.
Yeah, whatever was individual stock had the largest return, that becomes your top portfolio.
so let me compute the, I was saying once you have the MVP, you should fill it out until you get 119, right? But how do we get 0.77? This is when we come up with the MVP, right? So MVP means what? You minimize variance by changing the weights, right? This is true. You want the weights to equal 1, that's true. You want the weights to be positive, that's true. You do not want the return to equal any particular value. So you want to remove that, right? So I'm going to delete that. And now I'm going to solve this. And I'm going to keep the solver solution. And that's the only time I know that the return is 0.77%. I did not know this before that, right? So I know that that's the starting return, right? I don't need to compute anything to know this final return because I know logically that the only way I'm gonna get the high return is to invest all of my money in Johnson & Johnson, 1.19%. I forgot, was this per month or per day? Let me
Per
check
month.
What was it?
It
Per
was
month?
monthly.
Yeah, so that's not good. That's not bad, at least that's what I wanted to say. So now I have these two, but without using solver, you don't know what the MVP return is, right? Now, once you have this, you can fill out the target return column, right?
And what's of the STD debt that where does this come from?
The STD depth,
Yes.
right here. So all of the results from solver, it's automatically, so the weights and the return and the variance and standard deviation, it's automatically populated by solver. Because we tell it where it is.
And we just copy those.
Yes, and then we just copy and paste.
Mathematically copy.
Right, copy and transpose paste.
So from the second row, you're gonna add another constraint of return equals.
Yes. Yeah.
I don't know why my solver is not work for the second row. When I add
Okay,
another-
let's check.
Thank you. For example, I chose into row for
Maybe this one.
Okay, hold on. Hold on, I'm showing. So let me see that again. Okay, so hold on. Because I want to check everything. So B13, variance, okay. B2, B6, that's fine. And D8 equals 1, okay. B2 is 0. And then B12 equals what? B12. No, I know, but B12 equals 823.
Yeah.
0.97, right?
I joined other, but now it's not working. Maybe because of my
So try solving it. So I could not find. Oh, that's a different.
You gotta change your initial conditions at some point.
Yeah, could not find.
I'll figure it out.
So that's the problem.
Yes.
So I think the setting might be different somehow. You have to go back. Can you go back to the solver thing? So we yeah, something is.
So should I set objective of return value of this one?
No, because B13. Okay. You know what? Let's click on, let's close this. Let's actually check all of the inputs, right? So for example, portfolio return, okay, how about variance? Okay. Right. Okay. So that seems to be working. Let me see other settings for.
It's not working.
Because it's the setup for setting for your solver that's different. So let's note I saw GRG nonlinear for you.
Yeah.
That's all right now. Yeah, because this is called rolling.
Yeah, that's a solver
Stack on
problem.
zero.
I don't
You,
know.
you get,
Oh, you know what? You know what? Try this. Start with 20%.
20%. Oh.
Yeah. Start 20% and see what happens. 20% everywhere, right? And then run solver again.
if you get it again, you just take smaller steps.
Still could not find.
I'll figure it out.
That's bizarre. it's definitely the setting for Solver somewhere. So you were, you had a question? No. All right. What is it? 281. So hold on. Show me Solver. Show me your Solver.
Oh, cause you.
Right? It says minimize C12, which is, no, it's C13. Yeah, it's variance, right?
Oh, yeah.
It's not return. And then change the variable C2, C6, which is the ACS. So you want C12 to equal A20, okay? C2, C6 equals 0. And C8 equal 1. Okay, so let's solve it again. Could not find a feasible solution.
Yeah.
This is bizarre.
But one add knowledge, of return.
Yeah.
Yeah, equal to
No, that's
this one.
fine. That should be fine, but there's something is going on, because you're not the only one with that problem. And somehow so it's a solver setup, somehow. This is what, Mac, Windows, right? And yours is Mac?
Yeah, it's smart.
Yeah. So it's a solver setup.
Really?
Right?
But mine was fine.
Let's say solve.
No, mine was
No, I
fine.
mean, it's not solver, it's not solver from solver, it's our setup
Well,
with
no,
solver.
it's called
And that
Morningstar.
something is wrong.
Direct.
Uh,
If it were to work, we would change, right?
Yes.
And then those weights, I would put here.
Yeah, mine was like totally fine.
Totally.
Yeah, absolutely, exactly.
And then for the following one, I would do.
Mine is not, it cannot solve.
820 to 821, right?
Yeah.
Yeah. Can you have a
So
look?
if we
I don't even know if I.
Yeah. Every row
Yeah.
came from solver. And you have to copy
Try
the
Weaver.
way it is, yeah. The ways,
Which one? Weaver.
this is not an negation, so you don't know these in advance.
Yeah, but for some
This one
reason.
is.
Yeah.
Yes.
Yeah, it looks like it's.
There's so much stuff.
This is to the MVP right here, these two. So I had that right, because these are the weights, and then I added this constraint.
Good enough.
Is that question for me? One and I think I did something
So we must be making
No, I
an
texted
error.
the other day and I gave it to him, and
Let's
it was like-
go back to solve one.
to send it like
The
It's
solver
not even
setup.
that, but it wasn't that wrong, it was just that I had two
Okay.
things that weren't right.
So-
But I used this stuff.
So
and I
C-
think- Yeah, I can look at it if you want to look at it. No, I fixed it, so it's fine.
Yeah, that's the
I got it
return.
where it was.
Is that what you,
Actually, I didn't do the same with page because I
That's
was
the way
using the 0.6, like 1219 minus 0.77 divided by 8. Like, not exactly the same answer.
for the M, or
So, not the same. I can show you.
Try and uncheck this.
Yeah, I can show you. It's not the same.
Oh, it's still the same, hold on.
It's not the same. It's like the return.
Let's click on options.
Like totally work.
Divided equally.
Yeah, I can divide it with.
Let me check that. So I'm gonna check, because a lot of people have that problem, actually.
Can I see your laptop, maybe? Because I think I'm having the same, like the returns are not like
Yeah, it's not wrong.
Yeah.
It's not, if you are using like equally separately, it's not the same.
Okay, yeah, I'm using it.
So, okay, I'm gonna ask you guys to, those of you who have problems, those of you, not problems in the sense of what we're doing, but problems with solver, right? So let me show you my solver settings that makes it work, right? So click on options, right? And the first tab, all methods should look like that. And if not, make sure it looks like that. Right? So there's 3 tabs. We're gonna go through all 3, right? So
Before I do the selection.
do we all see that? Raise your hand if you're done with this. Yeah, no, this. This is only for those of you who have problem with solver, right? Whose solver does not work, because it says no solution found, right? So point, I don't know how many zero this is, 1, 2, 3, 4, 5, 5 zeros. Point, 5, 0, and then 1.
You can
That's-
decrease that. Make you can take one of the zeros away, it should help it.
That's fine. We know that this works. I don't wanna change it, right? So that's number 1. Number 2, and actually this is the most important one because that's the choice. That's actually the choice. So 2 things, right? So it's 3 zeros and 1, so 0.0001 for convergence. And the derivatives are central. Then population size 100, random seed 0. Raise your hand if you're done changing this.
Professor,
Yeah?
some on the percentage of the return.
You said-
Yeah?
Yes, so what's happening, because if you try to do for the second one, it doesn't produce a result.
Yeah, that's what you're talking about.
Okay.
That's what you're talking about.
No.
It's because of the settings for solver. So the settings are not the same as mine, and so somehow, right? So let me repeat, right? So for all methods, the constraint precision is 0.50 and then 1. And then when you click on the algorithm we're using, GRG nonlinear, convergence has to be point and then 30 and then 1. And the derivatives should be central, population size 100, right? And even though we're not using evolutionary, I don't know that there is no interaction between these algorithms. So let's make sure convergence is again point and then 3 zeros and 1. And then you have mutation rate of 0.075, population size 100, random seed 0, maximum time without improvement 30. Yeah?
I found a problem, the main problem of people because the cell A19 and B19, they link the formula to the C12 and C14. So if that happens, the solver is out. So you need to base the value, like you do is like you base the value already, but we will link you the formula.
So what you're saying is,
Oh, you made a circular loop, that's why it's not convergent.
Yeah, that is a circular, yes.
Yeah,
That's
so
happening.
you gotta paste those as a value.
which one?
No, the 19.
0.77.
The zero, the MVP.
Yeah, what about MVP?
We did equal it with the C12.
Most of people use the equal to
Oh.
C12.
Yes.
You just gotta paste
Ah.
it as a value.
Yeah, so that's.
Folks, you have to work harder. You have to copy and paste the return as well.
Yes.
Right, thank you for that, thank you.
That is the problem.
So the problem was, right, apparently this was equal to that.
Yes. and
So,
it's just
yeah,
circular.
yeah. Poor solver. Thank you for that. Yes, when I say copy and paste, it's everything, not just,
Okay, nice work.
right, not just the weight. The standard deviation and the return also have to be copied and pasted. Obviously, once you have a particular target value, you don't need to copy and paste the return again, because it's gonna be the same value. So, now that we've cleared that up, thank you for logging in. Let me know when your sheet looks as pretty as mine. Yeah?
I don't know, like
computer. That's like engineers, so used to. Huh? More, yes. Thank you, that's fine.
So I have the first one.
Yes. So let's get the second one.
Right, so
Hold on.
what should I change?
Hold on. Let's cancel. Let's go to 0.77. Okay, it's just the value. Okay, I just wanted to make sure.
Yes.
Okay, so let's go. Solver.
Yeah, what should I do for generate the next one?
So the next one, you just say add. That one? You know the first one? What does it say? Can you read it?
So C12 equals 820.
So all we need to do,
Equal.
keep over
Yeah,
and over
that sounds
again,
good.
copy,
So let's
paste.
keep, let's
Do something
click on
like
solve.
But you gotta do this manually every time. You just.
What does it say?
Copy this and you go through.
So found the solution, click OK.
I have to change
Oh, yeah.
There you go. You see these weights? Starting at 15.93%.
Okay.
It's the same as mine.
Just I don't understand what change
You can do it.
The weights.
Not for yourself.
Okay.
Literally, this is new.
Yeah, but what change did generate all this difference?
Oh, we added a constraint, which is the, so the MVP said, the MVP was the safest
So I want how to get it done, because I was sure we're gonna lose power.
regardless of returns. Right? So now we want a particular return.
Okay, but, so if I generate the next one, then, so I just understand we have like, I don't know how many lines.
Yeah. So if you want to generate the next one, change your target return from A20 to A21, et cetera, et cetera. But before you do that, you need to copy and paste the weights that you have right now. And you need to copy and paste the standard deviation
Okay, so I.
by values, right?
I have to just change the first constraint from 820.
Yes,
not 821.
that's right.
That's all I need to do.
Exactly.
Understand.
Exactly.
Um,
All right, does anyone have questions?
I have a question.
Yeah.
So, sorry, I'm so stuck on
No,
this part.
that's fine.
So, you have it going from 19 to cell 28. And
Yep.
you're supposed to do, this is the formula that I have. I'm gonna copy and paste like the actual numbers, but I just wanna make sure that this makes sense.
So, okay, first of all, let's go on sum. I just want to make sure of the formula that you have there, okay? Portfolio return, okay, variance, okay, and standard deviation. Okay, so everything is fine. Let's go to solver, because that's where the magic happens, right? So now, so this is what you use to get the MVP. The difference between the MVP and all the other portfolios is that the MVP is the safest possible portfolio, regardless of return. Now you want to target higher returns than the MVPs.
That's when the variance.
So you can add, let's add. Yeah, so you want to say that you want the portfolio return, which is C12. Yeah, that one. You want it to equal that particular value. And say, no, don't say add, just say okay. And now click on solve. Okay, so click OK. And if you go up, see these weights? They're new.
But my thing is this just changed, which is what, see now it has this. I just, like, this is the problem that I'm having.
Oh, I see what you mean. I see. Okay, hold on. E5, what is this? A19 plus E5 minus C5. What is E5?
E5 is this return, the largest one. And then, so you said, like, you wanted this return minus, well, it was supposed to be 77.
This creates some.
Divided by.
This is not gonna work.
So I have to do.
Yeah, because C12 is gonna keep changing. So instead, just do this, right? the next one, let's say that one, it's gonna be whatever this previous one. So yeah, choose it, plus, and then now you can compute the difference between, yeah, that one with plenty of dollars. Yeah, but you have to
Oh,
have
yeah,
$4 there. And then $4 and then 2 commas. Sorry, close parenthesis, sorry about that. Right, and then divided by how many, 1, 2, I think it's 9, divided by 9. Okay, let's go. And let's try and drag it. There you go, perfect.
But it's not the same as what's on the board, is that?
No, because I didn't do it like that. I just,
You just copy it?
yeah.
Okay. And then do I have to do something for the standard deviation as well?
No, because standard deviation is copied and pasted
Oh,
from
the-
Solver,
Okay.
right?
Okay,
Right.
thank you.
No problem.
Professor, we also need to copy not just the weights, but the standard deviation.
Yeah, so every time you, the whole return column has to be populated, number one. And then once you have this, every time you use Solver, you need to copy and paste the results, which includes standard deviation and all the weights. Right, absolutely. And again, if you have questions, just raise your hand, I'll come to you. Our discussion will stay private. But I need to know that everyone in class knows how to do this. Because things will not get easier. I have to be frank with you. So.
You gotta curve.
And if someone is done, let me know so I can check your work, okay? Yeah. So why don't you do this? Why don't you draw a picture, a chart, right?
Do you want
So,
to look at the anything else?
Yep.
So once you're done, you can push the envelope and do this, right? So because we're using exactly the same stocks, the shape of the efficient frontier should be exactly the same, right? So you have to practice making charts as well in this class, so there, right? So on the y-axis is the expected return, the target returns, and on the x-axis is the standard deviation, right? So I would check not just your numerical results, but then your curve, your efficient frontier, because this has a very specific shape, right? Because of these specific stocks, or these specific components. Who else is done? All right, let's see. Yeah, that looks good. Yeah, look, it has that that very abrupt change for sure. Can I see the results? So,
It's like crazy.
no, that's fine, because you're not, oh, you used exactly my numbers, okay, so that's fine. Let's see, 15.
I plus with 0.05.
That's fine. That's exactly what I did. 8.33. those of you who, use exactly my, my target return, and again, I told you guys, for your own sake, do it better than I did, right? By adding, so you take 0.77 and you add the difference divided by 9, right? The difference between 119 and 0.77 divided by 9, so you have equal increment, right? But if you did exactly like this, you should not expect the weight to be exactly the same, right? Why? Because the algorithm, the solver algorithm, like all algorithms like it, right? It does approximate the solution. It's not gonna find the exact optimal solution.
For the last number,
For you? Good.
It's not mine yet, that's halfway, but so far I don't know whether I
Mm-hmm.
the other thing we're running into, the last number we have is 100%. You're running into a not possible solution. So you gotta
Yeah.
drop that down a couple of percents to get it to
Yeah.
converge.
Yeah.
That's the only thing that's coming
Yeah.
up.
Yeah. And honestly, I didn't even try this because I just knew.
Yeah, it's,
And-
well,
and
people
this-
try it, it's not gonna converge.
Yeah, and then this was just to make sure everyone understood, this was real, there's no solution.
But if you drop it down to like 1.499, it usually will converge.
Yeah.
when it was mentioned transport, maybe I showed that's what exactly you mean on that. Like when I, so like if I select the weights, like that.
Yeah.
So, and if I put the here, then I use this.
Transport,
Yes.
yeah, yeah.
Just to make sure.
Yeah.
Hi, Professor.
Hey, go ahead.
Hi. Can you, yeah, for the raw 20, cell 20, 21, can you do a show because we're an online, we're not getting the whole discussion here.
Okay, for cell 21?
Yeah, 21.
Okay, so for cell 21, so first of all, your value does not have to be my value here. The only thing I did was add 0.05% to every previous return. The reason why this is not the optimal thing to do is because you do not get equal, you get equal increment, but it doesn't go, like from 1.17 to 1.99, that's not 0.5%. Anyway, it doesn't matter. You do whatever you need to do. My suggestion is the formula for here should be, right, here 0.77 times the difference between 119 and 0.77, the whole thing divided by 9, right? And then here, whatever that difference is, you multiply it by 2, multiply it by 3, etc. So that's the first thing. Now, let's say you chose to do it my way like this. Okay. So 0.87%, I'm going to go to solver, right? And really, the difference is, first of all, I don't change anything, right? I'm still minimizing C13, which happens to be the variance, right? I still need to find the weights right here, right? C2, C6, I need to find these weights that minimize the variance, right? It's the constraints that are different. I still need the weights to be positive or 0. I still need the weights to sum up to 1. But I need to add one more constraint. What is that? I need my return, which is in C12, to equal, so I'm going to look for the equal sign in the middle right here. I need that to equal A21 right there, right? And now I'm going to click OK. And solve. And if you found a solution, I'm gonna say okay. And, you know, this is how we get these weights, right? 12, 18, 21.23, which I copied and pasted here. And this is how we got this particular standard deviation, which is 2.73%. And then that, you keep doing that for a different, basically the only thing you change after that is this particular, let's try this. So I'm done with 0.87%, right? So I'm gonna change, I'm clicking on change, and I wanna change the target, right? Instead of A21, I want A22, so let's try that, right? A22, right? And so I'm gonna say okay once again, and I'm gonna solve it. And you've noticed that the weights have changed dramatically, right? From, for example, IBM used to be 12.18%, now it's 8.23%, which is what I've copied here. Does that make sense?
Yeah, thank you.
No problem. Right, so as soon as you're done with this, show me the numerical results and the pretty picture, right?
I just tried with the minus 25% return and it exactly was 100% IBM.
Okay.
So,
Yeah. Okay, that's pretty good. Because it is, you know. No, that's fine, that's fine. That's perfect. Excellent. So, you know, not a lot of people are done, so we're gonna make sure everyone will be done. For those of you who are done, you can use your time productively by collecting reading assignment 2. And assignment 2 starts like this. So at the very least, you can do that part, like, starts like this, right? Download the closing prices from January 1st to December 31st for each one of the components. You know, ultimately, when you look at question 3, I'm asking you to use Solver exactly the way you guys are using it today, but use it on the components of your stock track portfolio. Right, that's the idea. Yeah. That's fine. That is fine. Nothing wrong with it.
Not apply for that, just apply for the stock.
No, so that's a great question. So any investment you have, doesn't matter what it is, right? Normally it should have historical data from last year, like closing prices every day. That's all you need. And then compute the return. Now, let's say there's an investment that you chose, right, your portfolio, and there's no data available. Then my question is, why did you choose that particular investment? If nothing is known about it, right? You see the idea. But I'm just kidding. The data is available on stock, right? So, yeah. 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 So I can tell you this is correct.
And one more thing.
Yeah.
I just wondering, like,
Yeah.
how did you actually download this? Like, I think this is the return from
Yeah. So these are not from StockTrack. These are from Morningstar.
But like, yeah, I was logging into the Morningstar, but I just have
No, not Morningstar. Morningstar Direct.
Morningstar Direct.
So yeah. So just a quick. That's a great. Thank you for that question. So the data I downloaded, and the platform that you should be using is not Morningstar.com. I mean, it's fine, right? But the one that's more advanced is Morningstar Direct, right? That's usually an app that you download on your laptop. And I kid you not, it works like Bloomberg. Right? It's got as much information and data as Bloomberg, except it's on your laptop. What's not to like? Right? No, what's not to like? Getting the data is a little bit more complicated than just having it on from StockTrack. That's the. But the other side of it is, it's a good thing to, a good skill to have, because it's used a lot, in industry. So.
And then how about this, someone has a very good emotions, same story?
Same story. I mean, so that's a great question. The question is, what if we have options in our portfolio, right? Can we? So the idea is that as long as you have some source where you could estimate, expected return and variance and covariance, that's all that you need, right?
So for assignment 2, you want us to do daily for 1 year?
Huh?
So for assignment 2, you want us to do daily for 1 year?
Yeah, daily for 1 year, and the main reason for that is more because once you're gonna do something else, it's gonna require downloading the risk-free rate and the market risk-free rate for 1 year, and the data only goes from stops on December 31st. So that's the main reason.
Because I did 5-year, 12-month, or for 1 month when I did this, but I guess we're doing it again.
Yeah. Okay, it's good. Get a picture of it so that it looks like, one line, like this.
So I'm actually looking into like really
Yeah, efficient frontier. Right. So the correct, so all efficient frontiers are different. They always have the same upward sloping shape with this hump, right? But this one has a very pronounced hump, somewhere around whatever that is, 3%. Right? There's a abrupt shift in the slope.
You just highlight the weights, right, and then create
No,
the graph?
no. This graph is the graph of the return versus standard deviation. Literally, it's the graph of these returns against standard deviation. So it's an opportunity for you guys to practice making charts.
I can't believe I gotta download all this stuff again.
What, making charts? So you basically select the data, making charts. So let's say, I'm gonna copy that here. And I'm gonna copy this here. Is a return. And just so we're gonna select all of it. I'm gonna click on insert and then chart. Right? So select your your X data and your Y data together, and then insert and find the chart. I'm gonna try and find it somewhere. Recommended chart. There you go. So in this case, it's a scatter chart. I'm gonna say okay. Ag.
And the 1.5 liter volume that just solver cannot find the solution because there is no position in the portfolio that
Yeah.
can generate that.
That's correct.
Also, we couldn't go below minus 25%.
Minus
So
25.
0.25%, right? That's a minimum.
So, yeah,
you couldn't
that's a
go-
great question. So, for those of you who are done, please pay attention to the following, right? So at some point, clearly not today, and not anytime soon, but at some point I'm gonna ask you, first of all, what is the expected return for your current portfolio, right? You're gonna answer that by using some estimates of the individual returns. So for example, here in column E, we're using historical returns, right? So these are our estimates today, right? At some point, we're gonna use something else. But the point is, these are our estimates, right? And given these estimated returns for each one of the assets in your portfolio, you can then, just by plugging the weights in column C, you can come up with a portfolio return right there, right? In, what is that, C12, right? You have that portfolio return, and then I'm gonna ask you, find the optimal version of that portfolio. What does that mean? Well, if that return is above the MVP, it's somewhere in here. We know it's not gonna be the highest, so it's somewhere in here. So basically you use solver exactly the way we've used it, and the only thing you add is you want the return to equal whatever that value of your book. And that's gonna find the weights, which I'm gonna call the proper weights, at least according to this model, right?
Oh, we just stop this
So that's the general idea. However, there is the following possibility, that your portfolio return is actually below the MVP. You cannot target that return. So what are you supposed to do? So literally, that's the situation that we talked about. At some point, let me see if I have a picture. No, I'm not gonna have a picture of that here. So this is the situation we talked about last time. Where basically, if this is the, this return for the MVP is 0.77%, maybe your return is below that, right here, right? So instead of saying, I want to minimize variance for this particular target return, what are you supposed to do? Excel will compute your portfolio variance, correct? So what do? You change solver, and instead of minimizing variance by targeting this return, what you're gonna do is target this particular variance and maximize return. Do we all understand that? I will repeat this again when the time comes, because this is an exception that you have to be aware of. Right? Sometimes your actual your actual estimate of your return is lower than it needs to be, then there's no point, that's in English what I'm saying. There's no point in targeting that low return, knowing that you could get at least 0.77%, for example, which is the return of the MVP. So if you get that return, the only use for it is for us to say, okay, that particular return will have a particular standard deviation. Maybe it's not even this, maybe it's not even safe. Maybe the standard deviation that you have with your weight is gonna be here. This is the standard deviation. Maybe that's the one, right? So for this standard deviation, guess what? You can get a much higher return right here. Right? So that's the point. We're not there yet. I just want to make sure we individually know how to get this. All right, who else is done with this? Okay, so I've already checked you that. Yeah. 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 Okay. Good enough, it's still good enough. Okay, so it's the same story as before. So let's cancel it. So it's the same thing. So basically, let's look at these. So what is that? 177, and then the next one. And then the next one. 27, okay. Okay. And then, let's see these returns. These are, these are historical, right? Yeah. How is these? Okay, these are just, let's look at some. I'm just checking all of them. Return. Okay, and back. Yes. You can just type it once and see. No, that's the thing. Don't. Oh, that's fine. Okay. All right. Because you're not supposed to select anything here. You just select. So these are okay. Let's go. Let's go back. Actually, maybe you were showing me that. Let's go back to solver. So when I see by changing, oh, hold on. Changing, can you move this a little bit? So it's 3 that sounds good. And then you did C4T. What is C4T? That's the, okay. We do not want to do anything with standard deviation. Basically, we want to do this. We want the return to C12. No change. So instead of simple things, now it's cloud. So single song. No.
I don't know if it changes it.
Let's do this one. Hold it. Click OK. And let's go and solve. Okay. Perfect. So, right? Now, if you want the 0.77 for that one, let's just go back to solver.
Oh my God.
You have to
No,
remove,
I haven't.
and then for everything else, you need that. No problem.
I just don't feel back here.
Oh.
Just
Okay, we check over just to make sure that you.
I cannot wait for it to morning. I'm just
Okay.
sick of this shit.
Do you have the picture? The one that you made me,
Oh, the short.
yeah,
Okay, I'm going to.
right? This shape is very, very remarkable because there's
The
a
one
abrupt
about the July.
change in the slope. So we want
Oh,
that.
And I just try to ask, like, if I want to actually force to have a less than or minus 25%, 0.25%, less than that, that's not possible, right? It's possible.
So, okay. That's a great question. I think I did answer it convincingly. So, based on what we're done, let's say we want a return of 0.5%, which is below the MVP, right? Technically speaking, can we run solver and get a solution? Yes, we will get a solution,
Put it in parentheses.
but it's a bad solution, right? Let me again explain, right? So here's why it's a bad solution. So our MVP has a return of 0.77%, right? So if you want a return of 0.5, and we say, I want this return, and I want to find the portfolio with the smallest variance using exactly the same solver settings that we're all using right now. Here's what solver is going to give us. This is the smallest variance or standard deviation for that particular return, and this is the portfolio whose weights we're going to find from solver. What's wrong with this solution? What's wrong with it is for this level of risk, variance or standard deviation, right? Variance is sigma squared, standard deviation is sigma. For this level of risk, we actually can do better right here with a higher return. Right? This is like the miraculous result. So that's the idea. Technically, mechanically, solver will give you this particular result with the smallest risk, but that's not good. It's not good because for this level of risk, you can do better. And this is when you have to flip the solver setting by saying, this is a constraint. This variance should equal whatever that value is. And the objective is no longer to minimize portfolio variance, it's to maximize return.
And so, not regarding the solver, just theoretically, we have this window of returns.
Yeah.
Between minus 0.25% until
Yeah.
plus 1.
Yeah.
I think that's
Yeah.
the range only I can move in using these assets. There is no other way to
Yeah.
go inside.
Right.
That's what I work.
Sure.
Just to make sure I'm just making.
Yeah. But a big chunk of that range is irrelevant,
That's a
right? Anything below the MVP return is irrelevant.
I see.
Yeah, that's the
It's
answer.
not okay. Yes.
Yeah. Alright, so I'm gonna see how you guys are doing. looks good. So you're done? Yeah. You're done? And we go to the quiet area. So, take your time. You're comfortable with it? Yeah.
Well, I'm not doing anything right now, I'm just.
Okay. Okay. Let me check it. So let's go to this set. Okay. How about the full return? Okay. A variance. So actually it's 8%. So let's go to variance because I didn't recognize that formula. Okay. Yeah, because this is a math, right?
It's easy. Just
I
open
didn't
the
know
return
that.
here, open the return here, and then like insert the chart.
But basically the idea is, so let me show you the formulas, because you need to use those exact formulas to get it right, right? So, right, so portfolio return, it's gonna be that. So, yeah, did you get that?
Yeah.
Okay, so and then for variance, got it?
Okay.
And then hold on, and then standard deviation. Alright, so once you get it, you can start. Let me know when once you have all those down. How are you guys doing? Hey, perfect. I don't need to see it. It's great. All right. Okay, so it looks like pretty much all of us have this section. So that's good news. And well, you know what? Since you guys worked so hard, it's time for a break. What is 7:55 plus 15, whatever that is. What is that? 8:10, right? Alright. Okay. So see you at 8:10. At 8:10, we're gonna start. 8:10, we're gonna start talking about the CAPM in a technical way. Yeah, that's what that should be more. I'm gonna change it now. Yeah, yeah. I'm gonna change it.
Copy and paste the first variance in this A19. And then do A19 plus highest return minus the variance divided by 9.
I was when I was in high school.
Oh, okay.
But that will not be the thing that I want to do again.
Oh my god. I get into the next round of Aeon after the test. I just received the email.
You're gonna get a job. There's no way you're not gonna get a job. That's what we did the test for the other night, right?
Sorry?
That's what we did the test for the other night?
As long as it's real.
That's what I was gonna tell you too. Oh, yeah. Hours are expected. We had,
How long is the last time?
last time we had snow like that,
10 years ago?
no, about 10 years ago. We were a million people that power.
But not now, because of now technology is very
The feeder lines went down, and they had big trouble. They got in lots of trouble from the state. Now they lose power more than 4 days, they get fined by the state.
Excuse me.
Yeah, the most important is the quality of it's okay because of
I believe in entropy. You know what entropy is? Measure of random disorder. short ones like that.
Alo. Bạn có muốn nói chuyện với bạn có không? Xin chào nhiều bạn nhé. Chào. Hello, hello, hello. Xin chào. Xin chào.
Sit down.
Bạn con mình
Actually, the easy first one was free.
All right, everyone, so let's get started, right? So, as promised, I'm just gonna discuss the CAPAN review in a way that will allow us to continue our search for quantitative model, right? So, and we're gonna go through some definitions. More importantly, you really need to know the assumptions behind this model, right? And then we're gonna talk about the results. The results is something you know, but maybe we're gonna use it in a form that you may be not familiar with. So first of all, this is no, overstatement. Literally, anything that you will learn in finance, that if you have learned in finance, is based on this, right? And the whole idea is, again, diversification. And how? And that's where this is interesting, right? And so we know that Markowitz came up with the whole math for the efficient frontier and all that. And then he extended it further. Instead of looking at portfolio, what are the implications for the individual assets within the portfolio? So he published about it, and then William Sharp also, John Michener, and Mosen. So a lot of people actually contributed to the CAPAN and came to the same conclusion. That happens a lot. But this was after Markowitz's work on the efficient frontier, right? So here are the assumptions, right? So as far as investors are concerned, so we're talking about individual investors, right? Individual investors care only about expected return when it comes to portfolios, expected return and variance of those returns, right? Variance is the measure of risk in this particular model, right? So for portfolios, this is not actually an unreasonable assumption. It turns out that most portfolios do have like what a normal distribution, right? Raise your hand if you know what a normal distribution is, right? So as long as it's a portfolio, it tends to have a normal distribution of rates of return. And so yeah, so we would statistically care only about return, average return, average squared deviation from the mean. What is the name of that again? Anyone? Average squared deviation from the mean. So I was saying we care about average return, and then we care about the average squared deviation from the mean return.
It's variance.
It's variance. Should we care about the average cubic deviation from the return? No, because it's zero, because it's a normal distribution. And that's what I wanted to get at, is that when you talk about the deviation from the mean, so when you think of probability distributions, totally random probability distributions would have a non-zero average cubic deviation from the mean. An average different deviation from the mean to the power of 4, etc., etc. Do we understand what I'm saying? Right? You elevate the difference from the mean to many powers, and totally random probability distribution will have actual non-zero values for these. Not true for normal distribution. And we're lucky in that sense, right? So this is a realistic assumption. Homogeneous expectations, meaning we all expect IBM to have some particular rate of return. Is that true? In general, it is. How does this work? Well, because we all read analyst reports, and then we make decisions based on these analyst reports. And do analysts tend to predict similar things? Yeah, right? There's known as, they're known to have what's known as a herd behavior, which is that when you're a professional analyst and your job is to go out there and say, oh, I expect the IBM return to be at 10% next year, the next thing you do is check what everyone else has said. Because it turns out, as human beings, we like to feel safe, which is normal, right? So if you say 10%, and all of your colleagues, all of your peers in the industry say 5%, guess what analysts tend to do? They change the 10% to be closer to the 5% consensus, right? It's psychological hedging. The whole idea is, if I'm wrong, I'm gonna look really bad, right? So it's better to be wrong with everyone else, but that's the idea. Bottom line, I'm trying to convince you that assuming that investors have the same expectations is not far-fetched, because in reality, that's what we do, right? We don't have expectations until we read some report, and then now we have expectations. But then all of the reports tend to say the same thing, right? And then all assets are publicly traded. Well, most assets, right? Like 99% of all assets available for trading are publicly traded, right? Yes, there are like private investments that are publicly traded, but those would not be assets that we can handle using any sort of financial or regular standard financial model. Because, for example, a private asset would not have like a history, for example, of well-measured returns, things like that, right? So yeah, so virtually all assets are publicly traded. Yes, there are specific exceptions, but we don't necessarily care about those because that doesn't apply to the vast majority of investors. Right? So that's as far as individuals. The assumptions are fairly, fairly realistic. And then we're gonna say all assets are publicly held. Not too controversial to assume. So all information is available. Well, now we're exaggerating because obviously there are inside information, right? So this is debatable. And then the rest of this, these two are what's known as simplifying assumptions. The assumption that there are no taxes. It's just to simplify the expressions. The conclusions will be the same, but the formula will look more complicated with taxes and also with transaction costs. Number one. And then number two, are these really assumptions that are far-fetched? Well, not if we invest mostly in funds, because funds have virtually no transaction costs for them, right? And the taxes are minimized. Still, these are debatable assumptions. Of course, the one that's most debatable, is this one. There is a risk-free rate. That's not a simplifying assumption. That's actually a critical assumption of the model, right? You remove this from the model, there is no CAPM, right? So, of course, because you guys know the formula starts with the risk-free rate, right? So there is a risk-free asset. We already talked about this. In reality, there is not, right? But we can use that assumption as an approximation as long as we talk about an economy. So if you use the US, you use the CAPM for the US, So in that case, it better be true that the inflation rate is low and has been low for a long time, for a few years, right? That's not the case. So right now, that assumption is not correct, but there will be times when it is correct, right? Having said all of this, right, so we're just trying to be rigorous, and this is why we're doing all of this. Ultimately, what matters is, do investors use this particular relationship? And the answer is yes, right? Because beta is all over the place. That's just proof that everyone is using it, right? And even if something is incorrect, if all investors use it, does it become true? Anyway.
Pretty much.
Right? It's known as a self-fulfilling
Prophecy.
prophecy. How much is IBM today? Just quickly. Say it again?
237.
237. So if for some reason the investing world tomorrow thought that the fair value should be 250, guess what's gonna happen? We're all gonna buy, right? Because we're gonna capture that profit. We're gonna stop buying it once it reaches what? 250. The reason for the 250 might be nothing at all. You guys see that? Right? So that goes on a lot in finance, and you should take that into account. So even if all of these assumptions are wrong, as long as people use it, the result, the formula will work, right? That's the point. All right, but you should know that the main weakness is this idea that there's a risk-free asset, right? So we've gone through this. A quick reminder, right? So at the portfolio level, right? So this is at the portfolio level, standalone portfolio level. We used to have this efficient frontier, the blue curve that you guys worked hard today to get, right? Well, if there's a risk-free asset, it's got 0 standard deviation, and it's got a positive rate of return, then all we need is the market portfolio. This is the market that includes all assets. And the weight of a particular asset is simply the total value of that asset in the market divided by the total value of the market, right? If the weight for IBM in this market portfolio M, the weight of IBM is the total market capitalization of IBM, in other words, price per share times the number of outstanding shares. And you divide that by the total market capitalization of the whole stock market. That's the weight, right? So we know exactly what this market portfolio looks like. It looks like the S&P 500, basically. And this risk-free rate is some sort of a government bond, right? And so these are the only 2 things you should be investing in, right? And we shouldn't care so much about the efficient frontier because it's just 2 investments, right? So that's the portfolio conclusion or portfolio prescription from the CAP Act. That's not really what we want to focus on. We want to focus on the on what happens to the individual assets, right? Before I do that, let me highlight something here that's extremely important, and I do not want to forget this. Check this out, right? So if you look at this market portfolio, right, and you want to measure its performance, you can measure its performance and use it as a benchmark. You can look at the expected market return minus the risk-free rate, and the whole thing divided by the standard deviation of the market, right? geometrically based on this picture, what am I measuring here? Anyone? What is that?
It's a slope.
It's the slope. The slope of that capital market line. Right? So this is the benchmark for portfolios. All portfolios should at least have this ratio. In other words, if you look at a particular portfolio P, and you look at the expected return for that portfolio, minus the risk-free rate, divided by its own risk, as measured by standard deviation, it should equal this benchmark.
That might be a good thing to optimize your portfolio to.
Ah,
That might be a good thing to optimize your portfolio to.
there you go. So, you know, if your portfolio ratio is less than this, then there's something to be done. If it's greater, congratulations. I don't know how you did it, but hey, it worked, right? Does anyone know the name of this ratio?
Sure.
Sharpe ratio. This is known as the Sharpe ratio. So the Sharpe ratio of the Sharpe ratio of your portfolio should at least match the Sharpe ratio of the S&P 500, for example. Questions about
Professor,
that? Yeah,
say for example, in the composition of your portfolio,
yeah,
you have an investment at the point N.
yeah,
It is on the top, and then you have another investment in risk-free assets.
yeah.
Yeah. So in computing the overall portfolio, how would you go ahead? Because we know that with the risk-free rates, we say the standard deviation is 0.
Yeah.
Yeah. So how are you going to compute the entire portfolio itself?
So, you know, so as far as that's a great question. So the question is, what if we invest some money, which is what most people are supposed to be doing, right, based on this picture. We invest some money here, and some money here, right?
Yes.
So, so let's do that. So first of all, practically speaking, so your question is, okay, let's see this is the portfolio P, right? So the question is, what is the expected return on that portfolio, and what is the standard deviation of that portfolio, right? First of all, we have Excel, right? That because you know, if we know basically we have on Excel, instead of 5 stocks or 100 stocks, we only have 2 things, right? And there's only 2 weights that we're gonna compute. And remember, there's a cell that computes the portfolio return and a cell based on the weights. So it is feasible, right? That's the first thing. Excel can do it. Now, we can do it manually for sure. Let's say you invest a given percentage W in the market, right? So whatever that W weight is, you multiply it by the market expected return for the market plus 1 minus W, right? Because it has to sum up to 1 times the risk-free rate. So that's the expected return of your portfolio if you want to compute it, what's the word, manually, right? And then standard deviation, as you guys remember, comes from variance, right? So the variance of a portfolio. So I once did this on the board. Let me do it here. So usually it's the weight of the first asset squared, right? Times the variance of that particular asset, right? Plus the weight weight on the second asset, sorry, so let me actually weight on the second, so let's say weight on the risk-free rate. So let me call this WF. I should say 1 minus, because we know that's the weight on the risk-free rate, right? 1 minus WF squared times the variance on the risk-free rate, right? And then plus 2 times the cross product of the weight. So weight on the market times 1 minus times the weight on the risk-free rate times the covariance, right, between the market and the risk-free. So I'm just literally copying the formula that I showed you guys on the board. And by the way, if there's 3 assets, then you add squared weights of the third asset times variance of the third asset plus 2 times the product of the weight of the first and the third times the covariance between the two, plus 2 times the weight on the second and the third times the covariance between those, right? But we stop here because there's only 2 assets. Now, check this out, right? What is the variance of the risk-free asset?
0.
This goes away. What is the covariance between the risk-free asset and the market?
It's 0.
0, right? You know why? Because the risk-free asset never deviate from its expected value. And remember what covariance is? This is where it pays to remember and understand what they mean, right? What these concepts mean. So covariance, remember, is the average cross product of the deviations from the mean. But the deviation from the mean from the risk-free rate is always 0. So the cross product is always going to be 0, right? So this is gone. So now, basically the answer to your question is the variance for your portfolio is whatever the weight on the portfolio squared times the variance of the market. And in terms of standard deviation, you would say the standard deviation is simply whatever the weight you put, how much of your money, what percentage of your money you put in the market, right? Times the standard deviation of that market. So that's the answer to your question, right? So we can do it manually. It's a mess, of course, but we can. And that's the key, though, is that, before we think of doing anything on Excel or even coding it or anything like that, you have to be able to do it manually. Otherwise, you don't know what you're coding, right? So that's the point. Now, this does not look so good now that I look at it, but hey, that's, at some point it was clear, right? Does that answer your question?
Yes.
Yeah. This is the Sharpe ratio. Now, if let's understand this, because there's many ways that people in practice misuse the Sharpe ratio. So if in fact there is a risk-free asset, then it makes sense to maximize to have the Sharpe ratio as high as possible, right? If possible at all. In theory, that's not possible. It should be the same as the market Sharpe ratio, right? But even then, so here's the idea, right? Let's say somehow, so does anyone want to take a picture of this again? Now is your last chance, because I'm going to remove all of this. This is too much of a mess, right? And because I want to explain something about what I just said, which is this. If in fact there is a portfolio P here, and Okay, pretend that's a straight line. So, yeah, any portfolio on that line will maximize, will have a higher Sharpe ratio. Do we all agree? Right? Because it's got a higher slope. And then you can choose the level of risk you want, by investing more in portfolio P. And if you don't want that much risk, you invest less in portfolio P. Right? Does this make sense? Right.
StockTrack actually tells you your portfolio Sharpe ratio.
Huh?
StockTrack actually tells you your portfolio.
Absolutely. StockTrack does tell you what your Sharpe
Sortino ratio.
is. Absolutely. And I don't know if I think I wrote it. Let me check. It does. I actually. Okay. It does, but the ranking is in terms of raw return. Have you guys noticed that? Right? Not in terms of Sharpe ratio, because some people have lower Sharpe ratios than others, and they're ranked lower, right? So be careful with what you are presented with, and that's the first thing. You guys are risk managers. You want to take into account risk, not just pure rates of return, correct? Right. So normally this ranking should be based on Sharpe ratio. It would not change at the top, but then after the first, bottom line is there are people who are, toward the bottom who should not be at the bottom. End of story. I'm not gonna dwell on. But bottom point is, when there is a risk-free asset, then yeah, it makes sense to maximize the Sharpe ratio, right? However, just a quick trip down memory lane. When there's no, if we pretend there's a risk-free, so very often what people do is, when they think of a Sharpe ratio, they assume that the risk-free rate is 0. Okay, this is in practice, I'm just telling you what it is. So they assume this, so the Sharpe ratio becomes the expected return of the portfolio divided by its standard deviation, because the risk rate is 0. Do we all understand this? Right? So a lot of people do it like that, and they call this the Sharpe ratio. And basically they say, oh, this portfolio is the star portfolio. That's the best portfolio because it has the highest Sharpe ratio. What's wrong with this story?
Risk-free rate is 4.03%.
Number one, right? And then number two, if there is no such thing as a risk-free asset, right, and you use that as your Sharpe ratio, then you have to ask that person, so how, if someone wants a higher return than the return from portfolio S, how do they get there? You guys see that? Well, you have to compute the efficient frontier. And the Sharpe ratio is going to be different because the slope is different. The Sharpe ratio is a measure of the slope of the efficient frontier. Do we all understand this?
Right.
So it's wrong to maximize the Sharpe ratio if in fact you assume that there is no risk-free asset or the risk-free rate is 0, right? And that's the wrong way of using the Sharpe ratio. So if you use the CAPM, the Sharpe ratio should be the same as the market Sharpe ratio. You could find more, that's even better. But when you find more, let me emphasize this. If you find a portfolio with a higher Sharpe ratio, let's say this is the portfolio, I'm gonna try my best. Hey, looks almost straight. So if you find a portfolio like that, you're not forced to invest in it. What you should do is mix the risk-free asset with the portfolio, right? You're not forced to invest all of your capital in that portfolio. Do we all understand this? Because every portfolio on that line with a higher slope, all of those portfolios have the same Sharpe ratio. Right? So I don't want anyone to think that there's only one portfolio that has the highest Sharpe ratio. That's the error that people make. Find me the one portfolio that has the highest Sharpe ratio. There's an infinity. There's an infinity of portfolios that have the high. If you found P through some ways, then you can always mix P with the risk-free rate. By the way, let's talk about this also, because we've talked about positive weights, right? Some of you might be interested in taking on more risk and therefore getting more return, like something here. How do we do that? Well, clearly, if you invest all of your money in portfolio P, this is your return and risk. So the only way you go above that is by borrowing more money and investing that money into P.
You short the risk free.
That's right. So you have to use leverage, just like hedge funds, right? And so that's one way. That's the way to get a higher return than what's possible with existing assets, right? Okay. Let's talk about individual assets within this world, right? So individual assets would behave in a way that, and from now on, let me mention this. Every time you see capital R like this is capital R sub M, basically this is the difference between the market and the risk-free rate, right? So there's many names for this, right? This is known as the risk premium, right? Another name for this is excess return, excess over the risk-free rate, right? So that's the idea. So all that this says is that if the CAPM is true, then this ratio of the market risk premium over variance, it's almost like Sharpe ratio, right? The difference is the denominator is not standard deviation, it's variance, so it's not Sharpe ratio. But that should be a constant that's a measure of the investing public's risk aversion. It's very simple, right? If we investors are more risk averse, we would demand higher return above the risk-free rate for a given level of risk, right? Do we all see that? If we're more risk averse, this goes up, because this is a measure of risk aversion. Questions about this? I see a lot of frowning. I don't know if it's slate or. Yes. So the general idea is that what the researchers have shown is that when we actually look at the ratio of reward, meaning extra return over the risk-free return, reward to risk, so risk is measured by variance. We know it can also be measured by standard deviation, it's just a square root, right? So when you look at this reward to risk ratio, it should be a constant that's a measure of the investor's risk aversion, right? It's literally a measure of how much we like risk, right? You cannot invent a story, you just observe, right? You observe what is the market requiring from the S&P 500, right? And then divide it by the level of risk, and that's how you know, right? Does that make sense? Any more questions about this? Right. And really the insight from the CAPM, when you drill this down to individual assets in the portfolio, before drilling anything down, let me emphasize, so that automatically means that the only correct measure of risk when we talk about a standalone portfolio is variance or standard deviation. It's the same thing, right? The other one is the square root of the other, right? So that's the only correct measure of risk in this world for a standalone portfolio. So let me ask you guys a question, given what I just told you, right? So let's say you have a portfolio with two funds. Obviously, these funds are portfolios, correct? Let's call them Fund 1 and Fund B. I know it's not original, but it's late in the day. So Fund 1 and Fund B, right? Fund 2, wow. Fund 1 and Fund 2. Should variance of Fund 1 be the measure of risk of Fund 1, and should it also be the variance be the measure of risk of Fund 2?
Risk can have their own variance.
So, but variance is the correct measure of risk for what kind of a portfolio?
Mark.
Standalone portfolio. Write it in capital letters, choose red, preferably, and circle it many, many times.
Which you basically going to be covariance.
So, we're getting there. If you're way ahead of us. So, bottom line is that for standalone portfolios, variance is the correct measure of risk. We have not talked about portfolios that are inside a portfolio, correct? Right? You guys understand this? So here is a very popular way of misusing the Sharpe ratio. You manage a fund, and then you publish the Sharpe ratio. What's wrong with that? I mean, there's nothing wrong with providing the information, but is the Sharpe ratio the right thing to use for investors? Only, the answer is yes, only if they invest all of their money in that particular fund. Do we understand this? So if you invest your money, as you should, in many funds, it is wrong to judge the performance of these individual funds within your portfolio using the Sharpe ratio. Of course, you're going to ask me, what should we use then? We're getting there. But the point I'm making is, everything we've talked about is for standalone portfolios. This is why you have to apply to your stock track portfolio and all that. Does that make sense? All right, let's move on. And let's then use this insight, this one, and apply it to individual assets within a standalone portfolio. And this is the key point, right? So I'm skipping a lot of things. Feel free to ask me questions if you need if you need to go through the intermediate steps. But basically, let's say we're interested in G, the stock, right? So that's one asset in this standalone portfolio, right? What is the ratio we should pay attention to? What's the reward? The reward is still the same. It's the difference between the G rate of return and the risk-free rate, right? This is, I told you guys when it's capital R on this deck, it's basically the return, expected return on G minus the risk-free rate, right? But check this out. What's on the risk side? You don't see standard deviation there, correct?
No variance.
You don't see variance there. Why? Because G is inside the portfolio. We should not care about the volatility of G. What we should care about is how G contributes to the volatility of the whole portfolio. That's what we're measuring here, right? And yes, we talked about this, right? When we look at how G contributes to the total variance of the whole portfolio, this is the term. It's the covariance between G and the whole market. Okay? We don't care about the total volatility. We care only about how it moves in the market. You know why? Because if it moves a lot with the market, then it magnifies losses, correct? If it moves less with the market, then it does not accentuate losses. Does that make sense? Right? And that's why this is the, and by the way, you can also, I'm not gonna do it, but you can also show it mathematically, because when you compute the portfolio variance, once again, the market portfolio variance, and you collect all of the terms that has G with it, this is what it comes to, right? And you saw me start doing that with a 2-asset portfolio, and it was already a mess, right? But we know, if there's like 2 assets in the market portfolio, let's do that, right? What is the variance of the market if there's only 2 assets in the market? So it's GE and someone help me. What would be the only other asset in the market?
The market.
Say again?
It's the market.
Huh?
The market itself.
No. I'm just being hypothetical, right? Because I want to show the contribution of GE to the market risk.
So it's GE squared
So
plus
GE
the other,
and what?
another asset squared.
Apple. Let's say Apple.
Yeah.
Let's say Apple.
So GE squared
Right?
plus
So
Apple
literally,
squared.
Look at this, right? So the weight on G squared times the variance of G, right? Plus the weight on
Apple squared.
I forgot, what is the ticker AAPL, right? Squared times the variance of Apple. Then plus 2
Times the weight of
times the
one,
weight,
weight of the other,
right?
and the standard deviation of each.
Times the, right, times the covariance, let me write this down, between G and Apple, right? Literally. So how does G contribute to this market risk? So to the risk of the market portfolio. It contributes here by looking at the covariance with itself, right? And it contributes here by looking at its covariance with Apple, right? That's the whole idea, right? So literally, you know, when you look at, this is the covariance between G and weight of G, you know, weight of G and weight of G, and this is the covariance, and this is literally the covariance between G and Apple times their weight. So literally, that's the covariance between the whole market and G, right? If you add up those two covariances, any questions about that? So once you understand this, that risk at the individual asset level should be measured by covariance, right? Then you understand, and this is the main finding of the CAPM rating. Here, this is the main finding of it. If you look at individual assets, all assets should have a reward to risk ratio equal to the portfolio itself, right? What happens if you find an asset whose return to covariance is greater? Then you should invest more in that particular asset. Does that make sense? Right? Because it gets you more return for the same level of risk. And what if you find an asset that's less, that has a reward to risk ratio that's lower? It's gonna, when you invest in it, it's gonna lower your portfolio's reward to risk ratio, so you should forget about it, right? And that, you know, when you buy successful assets, what's gonna happen to this return? It's gonna go down because the price is gonna go up, right? In the same way, if everyone starts selling underperforming assets, what's gonna happen to the return? It's gonna go up because the price is going down. Does that make sense? Right? So that's really the capacity. Now, I'm gonna skip the derivation, but basically the idea is that if this is true, then you go through this, and you end up with this equation, which is something that you already know. All right? So that's the CAPM at the individual asset level, right? Questions about it, right? So you need to keep in mind the assumptions, the weaknesses, and there's strength, right? The strength, of course, is the simplicity of the model. I mean, this is the simplest financial model ever. There's nothing simpler than this. As far as pricing models are concerned, because let me tell you right now, there's multiple alternative pricing models, but they're all much more complicated than this. And so absolutely no one in practice uses them. The people who publish them can promote it, but no one is using it, so you know, it's not very useful. So once you know this, let me see. Okay, oh. So you guys see this? Here's a picture. Return, instead of sigma, we have
Beta.
Beta is a measure of how that individual asset moves with the market. If beta is 1, it tends to move in the same percentage change, right? If the market goes 1% above its average, then that particular asset also tends to go up by 1% above its expected return, et cetera, right? So This line, this line is known as the security market line, SML. So if you're gonna take the CFA and things like that, you need to know all of that. That difference between, at first it's confusing because it's all of these acronyms. Right? CML shows return versus total risk standard deviation, applicable only to standalone portfolios. Anything else is not a standalone portfolio, and the only measure of risk is beta, not sigma, right? And the name of the line is not capital market line, but security market line. Questions about this? CML is for standalone portfolios, and this is for individual assets. So for example, in your portfolio, you may have some funds, right? Let's say S&P 500 ETF. If it's in your portfolio, it's not a standalone portfolio. It's an individual asset in your portfolio. So can you use the Sharpe ratio on the S&P 500 ETF? The answer is no, because it's not a standalone portfolio. The way you use it inside your bigger portfolio. So you should use beta, right? So in that case, so let's say it's a portfolio. What this says, so this is the market, right? This is the market portfolio right here. This says that for the market, the reward, which is, again, the difference between expectations and the risk-free rate, divided by beta of the market, right? And the beta of the market, by definition, is 1, right? So when you have a portfolio that's not a standalone portfolio, you should compare it. You should compare that ratio with the market. By the way, what is the beta of the market? I will need to write it's 1, right? Because again, beta is a measure of the percentage change per 1% change in the market, right? So if the market changes by 1%, the market will change by 1%. So it's the ratio is 1. Right? So this is basically 1. So we can remove, and we want to compare these compare these market risk premium or market excess return. Right? Compare this with this ratio. Please note that this is not the Sharpe ratio, correct? Right? This is known as the Traynor. From Jack Traynor. The Traynor ratio. That is the correct ratio you should use if you're looking at a fund that's going to be inside your portfolio. You should not look at the Sharpe ratio. Questions about that? The story is very simple. If it's something inside a portfolio, the measure of risk should be beta. If it's the portfolio itself, as a standalone, the sigma should be the measure of risk.
So what if I have a portfolio which includes one ETF?
So the ETF's measure of risk. Any portfolio that's inside a bigger portfolio should not be judged with sigma. Should not be judged with a Sharpe ratio. Do people do this in practice? Yes. Tons of people do that. And when I say people, I do mean professionals, not like people off the street. Right? So there's a lot of things like that in finance, and you just want to be careful when you see people do that. You just want to be polite, but you know what you should be doing, right? That's the idea.
And Stock Truck gives you a Traynor ratio too.
I think they do,
They do,
right?
yeah.
So, questions about the difference between Traynor ratio and Sharpe ratio, and the proper measure of risk for portfolios, depending on if it's a standalone portfolio or if it's a component of a bigger portfolio. Do we all have this in mind? Yes?
And you mentioned again, just how to use each of them.
Yeah. Literally. You use this formula if it's a portfolio inside a portfolio. You change the formula by changing beta into sigma if it's actually the bigger portfolio, if it's the standalone portfolio. Questions? So this is a conceptual point, but it's a major conceptual point. Okay? All right. So I don't wanna move further than this. What I wanna do is I'm gonna go back and cover something that I skipped over. So we know what the CAPM formula looks like, right? When you look at individual assets. However, as long as we're talking about computation, whether it's on Excel or using Python or whatever, we really want to use matrices because you do not, let me put it this way. Let's go back. So, technically speaking, how are you going to get this estimate? Well, you need to know the risk-free rate, which you can read about. If you think it's the 10-year Treasury note, then you can read about it. If you think it's the 30-year T-bond, you can read about it, right? This expected return of the market minus risk-free rate, this is an estimate. So you have to estimate the S&P 500 return minus the risk-free rate you just read about, correct? But you don't know this beta. So the only way you do this is by running a regression, right? So you run a regression of the, let's say the G past returns, right? Against the S&P 500 past return. When you run that regression, the regression coefficient that you find is beta, right? I'm just assuming, but let me make sure. We all know when a regression is correct? Yes? Raise your hand if you have run a regression on Excel. But, okay. So, I'm not gonna, okay, let's see. I just wanna make sure, right? I can do this. Let's run a regression, right? 1, I'm gonna make up some numbers. 2, these are too small. All right, here you go. I have some numbers. This is this is the rate of return on a particular stock. Don't ask me how. It's 1%, I'll say it's 10%. It's a miraculous stock. And this is the, let's say, the market return. So it went the other way around, right? 10%, and then it went down to 9, etc. So pretend, oh, Jesus. So pretend this is the return, right, for a particular stock, and this is the return for the market, right? So how do you run a regression on Excel, well, you have to go to data, right? And hope that there's something here. The only thing I have is solver, unfortunately. So you guys help me out. I forgot. What do I do?
Excel
I need
add in
something.
data
Right?
analysis.
File, options, add-ins, go. And this time I want the analysis toolpath. I prefer the one with VBA. So click OK. And now you guys saw what happened? Data analysis right here. Because when I click on data analysis, I scroll down, guess what I find? Regression. Click OK. What is my Y? In other words, what's on the left side of my regression equation? It's going to be my stock return on stock. And what's my X? It's the market return. Did I select labels? Yeah, I did. And click OK. And here's the result. This is beta. For those online, this is beta. Okay, that's beta. And it's -1. Right? Of course, I totally made it up, so we have a miraculous beta of -1. But that's how you get beta. You run a regression like this. Questions about that?
So I'm running intercept.
The intercept, we don't care about. Right? That's a great question. We don't care about it because we only care about the coefficient itself. But I did it very fast, right? But I do not want to do this 100 times if there's 100 stocks. And I think you don't want to do it like that as well. So let's go with matrices once again. Do it once with one formula, right? So this is the formula. That's not it. All right. So let's go back to the. Let me try and find the formula right here. Here's the formula. It's right there. Instead of looking at it for one stock at a time, why don't we look at the whole vector of expected return, right? For what we need for the whole portfolio, right? And basically, oh, and again, remember this is an excess return, right? Actually, is that what this is? No, this is not. So this is gonna be confusing everyone. So this is now the stock return. So this is, if there's 100 stocks, this is there's 100 rows, right? And it says it's the risk-free rate plus. Do you remember A bar? What was that again? It's a measure of
Risk tolerance of the
risk
public.
aversion. A as in aversion, right? So the formula is risk-free rate plus A bar, which is the measure we just talked about, right? And then times V. V is the covariance matrix we computed a long time ago. Times W. W, guess what? W is the market weights. Remember what market weights are? It's whatever the market capitalization divided by total market capitalization. So that's basically what we're going to be using. So let me show you, before you go, maybe you're going to do some work and then we're going to continue next time. Actually, So the return, the CAPM returns are known, especially when you do it with matrices. You can call it CAPM return, but they're also known as, make sure, they're also known as implied expected returns, or IER, right? So that's another name for the CAPM return, so you should not be shocked by it. If someone else tells you about it, it's just the CAPM return, right? So if you go on the week 6 module on HASP-CT, you will find a document called IER inputs. I'd like you to download it on your laptop. IER inputs. Let me check that that's the name of the document. Let me see what the file is called. It's called mean variance data with HR work and IER inputs. It's much longer than. So, okay, let's see. Let me check. So here it is. Do you guys have it? So raise your hand once you have it on your laptop. Okay, let's read some more because half the class doesn't have it. All right, so who has it? Okay. This is the objective. And clearly yours does not look like that. Right? And our objective is for you to look like that, for your workbook to look like that. So remember that formula we were talking about? This one. Right? The one that says the expected return on any particular portfolio component is the risk-free rate plus A bar times the covariance matrix times the vector of market rates, right? That's exactly what I have here. In my example, my risk-free rate is 0.01% plus N8, you guys see it's called A bar, right? And then times the multiplication of covariance matrix G2, K6, and the market portfolio weights, N2, N6. How did I get the weights? Well, I looked at total market cap for each one of the stocks. And then I computed them as a percentage of the sum of the market cap. Right?
Well, we could do that for the market or for our portfolio that we're
Yeah,
making?
well, when you use this, you assume that your portfolio is the market.
Okay.
Great question. Right? So that's the idea. For today, like there's 5 minutes left. For today, I want you to compute some of these components. For example, A bar. So A bar is, if you remember, it's the ratio of the market risk premium to the variance of the market. Do you remember that? Right? It's a measure of risk aversion, I was saying. Right? So we want to compute A bar, right? I've collected the market cap, so you don't have to do that, right? But at some point you will compute the weights, and then you'll enter all of the inputs into this column D, right? Which is the formula, the matrix formula for the CAPM. Note that it's just one formula. I don't have to enter this 100 times if I have 100 stocks, right? That's what you want to avoid, correct? So let's do it. Not all of it today, but at least today, what I'd like to do, let's first talk about the data. What's the difference between these data and the data we've been working on today?
The risk-free stuff.
There's a difference between market and risk-free rate, and there's the risk-free rate. And then what I did was I added those two up. So I ended up with a market return. A standard database for this is the database that Fama and French have started, and French is still maintaining it. Who's heard of the Fama French model? So some, but not all. So I told you that there's an infinity of alternatives to the CAPM. So Fama French model, actually there's many Fama French models, right? Here's what they did. You take the CAPM, there's a beta, right? Beta times market minus risk-free rate. So what they did, and they have many variations, is plus another beta times some other index minus something. And then there's a version with an even longer, etc., etc. That's basically what they did. Why? Because longer is better.
See, because CAPM didn't take into consideration other factors.
Yeah, exactly. That's the argument, absolutely, right? Maybe there's additional risk factors. So as soon as you can think of something, you can add it, right? That's the idea. Right? Well, if it makes you a better prediction for the return, why not, right? Anyway, that's what they did. We're not going to use the Fama French model, clearly, because I spent a whole session talking about the CAPM, right? But we're going to use their database. So here's what you find of their databases. They collected the data. So remember risk-free rate, market return minus risk-free rate, right? Well, their model adds something else called small minus big. I'm not gonna go into that. And then HML, high minus low, right? Et cetera, et cetera. So there's actually additional, this momentum possibility, it's all kinds of nice stuff. We don't care about that. But guess what? We do care about these two columns. Market risk premium and risk reward. They've collected it since the beginnings of the New York Stock Exchange, 1926. What is that?
July 1st.
July 1st. Isn't that amazing? Right. And the reason why I wanted you to collect data on your assets in your portfolio for the whole year 2025 is that the last thing that they have right now on their website, I need to go faster with this. There you go. There you go, right? So, there you go. So that's the last thing they have. December 31st, 2025. Obviously, when you use the data for what we need, we don't need to go as far back as 1926. But it is there if someone needs it, right? So here's what I want you to do just today, right? I've already collected, for this particular example, right? I've already collected the market risk premium right here, right? And the risk-free rate, and then I added the two, right? So why do I do that? Because we need a couple of things, right? We need to compute A bar. Do you remember A bar? It's market risk premium, average market risk premium, divided by variance of the market, correct? So let's check it out, right? So Q63, average of the market risk premium, 0.81. Do we all see this? Yes? What is that? That's the average of the difference between market return and risk-free rate, right? So that's what I have, and then divided by S25 should be the variance of the market. Well, let's see if that's what it is, right?
It's 65.
So variance is S, what is that?
65.
65. Right here, right? So how is this variance computed? There it is. It's the variance of the whole market return. We all see that? So at least before you go, I'd like everyone to compute these two statistics, the variance and therefore A bar. And then next week we're gonna be able to move on to the next sheet. Right? So let's do that. The faster you do it, the faster we're out of here.
So at the end of project 2, we were supposed to use this
Yes.
at the end,
Yes.
but we're not going to finish this.
That's a good question. We're not gonna finish it, so you're probably gonna have to,
Push it off.
yeah, push it off, definitely. Great point. So the data is already there. All I need you to do is once again compute variance. By the way, have you guys noticed it's var dot S? What is that?
Sample variance.
Sample. Right, sample variance. And then A bar is simply the average market risk premium divided by that variance. Once you're done with it, let me know, I can check your work, and then you're free to go. Otherwise, I'm told that we can stay until 3 in the morning.
No, actually, kick us out at 11.
Well, it's it's 9:30, so you know what I mean?
I got kicked out of here one time.
All right, who's done? I need, huh? I need to compute these two things. The variance of that, and then take it and divide it by this, sorry, the other way around. Take this average market risk premium and divide it by that. That's A bar. All right, who wants to get out of here? Okay. Hey, there you go. Perfect. You're free to go. No one else is. Anyone else? Yeah? Perfect. Thank you. Yeah. There you go. Yeah. Excellent. A bar. So A, first of all, conceptually, A bar is the extra return you get in the market per unit of variance or volatility, right? And so the average. Oh, so you have to compute that average. By the way, you guys remember, right? So for your stuff, you don't have these averages, right? So you need to fill them out. You need this one in particular. Because you have to take this average return, excess return, and divide it by this variance, right? And then from there, we're gonna use the matrix formula for the component where we're ready to go. Yeah? All right. Anyone else wanna get out of here? Some people like this room. Yeah. There you go. The AMR is the average return. Yeah.